Welcome to our Taking Stock video for the week ending the 20th of September 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and joining me today is our Equities Analyst, Daniel Ortisi, to discuss all things share markets. Welcome, Dan. Great to have you on board today.
Yeah, good to be back for another week of Taking Stock and a very important episode today, isn't it, Kien?
It's always an important episode, Dan. But before we get started, just a quick yet important reminder: the information we provide today is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Also, here, just a reminder, we are conducting our virtual masterclass session in October, which has been specially curated to help you master Stock Doctor so you can invest more successfully. So make sure you register if you haven't done so. Well, Dan, another positive week on the markets with both Australian and US markets hitting new highs. And there's been optimism across equity markets, and that's been influenced by this expectation of US rate cuts, which end up dropping by about half a percentage point to that range of 4.75 to 5%. Although some investors took this news positively, others have been focusing on the reason behind why such a large rate cut was needed.
That's right, Ken. And in the words of Federal Chairman Jerome Powell, although the upside risk to inflation have diminished, the downside risks to employment have now increased, which is obviously something we've discussed a lot recently. Or in other words, the Fed is seeking to preempt any weakness or further weakening in the US economy, and in particular, their labor market.
Yeah, we've been talking about how there's been that kind of disparity between prices and fundamentals. And yes, that threat of recession is not yet over. Over here in Australia, though, the unemployment rate in August has been left unchanged from the previous month at 4.2%. In essence, though, similar to US interest rate cuts, this data point can provide both positive and negative connotations. Although a stable jobs market means a more resilient economy, it puts pressure on inflation and may keep our interest rates in Australia higher for longer.
That's very true, Ken, and something that all investors should consider. And this is what really is creating mixed messages at the moment. And that's why it's important for us to, do as we always do and block out the noise, maintain exposure to stocks, but also focus on risk management. Hold a portfolio of at least 15 stocks diversified across high quality businesses, whether it is for growth or income. And be active with your portfolio, removing those high risk financially weak stocks and take profits from over concentrated positions which have done well. Then allocate this capital towards opportunities, whether it be across oversold star stocks or perhaps other opportunities you may find amongst our stock filters and your own personal watch lists.
Yeah, risk management is so pertinent, Dan. But on the topic of US interest rate cuts, I noticed that the price of gold rallied, providing support for our gold miners, Capricorn and also Perseus Mining. Investors may be wondering why this is the case, though. Well, gold benefits from interest rate cuts because it reduces the opportunity cost of holding this precious metal, which does not provide a yield. In other words, the yield on other asset classes like cash and bonds become less attractive to investors.
Additionally, Kian, interest rate cuts tend to weigh on the US dollar, and that makes gold cheaper for international investors on a relative basis, which can create additional demand for the precious metal. Last but not least, of course, the increasing level of geopolitical risk, especially following the escalation in conflict between Hezbollah and Israel, does tend to lead to higher demand for risk-off assets such as gold, which is a precious metal.
Yeah, it's also leading to a slight pickup in the oil price as well. So we'll be watching that closely. But across our star gold stocks, I noticed that Perseus Mining, they experienced negative earnings revisions over the last 3 months, despite rising gold prices and announcing a recent share buyback. What has contributed to this, Dan?
Yeah, even though Perseus did beat market expectations in FY24, the miner is expected to undertake an elevated level of investment in the upcoming year to replace the production profile of their depleting assets. In addition, costs per ounce is also forecast to increase by double digits, while production is expected to either remain flat or possibly decline from a very strong year in FY24.
Yeah, Perseus does have a very high return on invested capital, but another key risk investors need to be mindful of when investing in Perseus is that the business operates in Africa, which is susceptible to military conflicts and sovereign risk, hence why it tends to trade at a discount to its peers within the gold space.
That's very true, Ken, and really good to point that out as an active risks. Those who aren't comfortable with that may want to look at other options within the gold space, and one that we've covered is Capricorn Metals, which has its assets located in Western Australia. And you can also see that it has positive earnings revisions and is generating a higher return on invested capital. Otherwise, you may want to consider some of the larger cap gold players, such as Northern Star or Evolution Mining as well, which reported strongly.
Yeah, thanks for that, Dan. But turning our attention now to the recent Star Growth stock initiation, Infomedia, it is quite a unique player in the automotive tech space here by offering software solutions like electronic parts catalogs and service quoting tools to automakers and also dealerships.
It is indeed a very interesting company, Ken, and of course, one that has been a star stock in the past. And with return on equity expected to be over 17% this financial year, it certainly is looking attractive under those metrics in Golden Rule 2 and 3. Some of the growth drivers include ramping up their global footprint, especially in markets such as Mexico, Canada, and Asia. And for example, the business has secured contracts with automakers such as Chery and MG, which has boosted their recurring revenue. Further, products like Super Service and Microcat continue to grow steadily, and its newer product, InfoDrive, is seeing double-digit growth globally as well, which is leading those strong revisions in Golden Rule 3.
Yeah, quite a number of growth drivers there, Dan. And I'd noticed that the company's liquidity under Golden Rule 6, that's slightly on the lower end, with around 350,000 average daily trades. Now, this amount might not be enough for institutional investors. Meanwhile, those high net worth investors should really ensure that the average daily trade is at least 5 times their initial investment before considering the stock. This week, we put youth apparel retailer Universal Store Holdings under the spotlight. The company was recently initiated as a Star Growth stock, and just a bit of background, they are a retail business that designs, wholesales, and also sells youth-orientated fashion wear in Australia. As such, their target market is typically that younger demographic. The company suits growth-orientated investors who are comfortable with the active risks associated with a cyclical retail industry and believe consumer spending will be resilient on the back of potential interest rate cuts. Dan, I noticed though that there's been significant positive earnings revisions under Golden Rule 3 over the last 3 months. So what's contributed to this?
Well, Ken, the revisions are driven by really strong sales growth and the expectation of a further expansion of their store network. In FY23, the business opened up 8 new stores, including some of those under the Perfect Stranger and Thrills brands. Their revenue was up 27%, which beat expectations. And furthermore, like-for-like sales growth over the first 7 weeks of this financial year have been really strong at around 12%. All in all, the company does appear to be executing well, especially considering the competitive retail landscape.
Yeah, we've been monitoring this stock for quite some time now, and I do remember that it was only in May of 2023 did Universal Store Holdings, they released an earnings downgrade. Back then, they cited increased promotional activity and tightening conditions. And that downgrade was due to higher costs and also inflationary pressures that affected their margins, alongside weak consumer demand at that time. But since then, the share price has bounced back, but this is something we'll be watching closely, especially with the weak consumer spending, which is still quite prevalent right now.
Absolutely, Ken. Of course, for any retailer, you want to be very cognizant around the current demand and consumer spending. On a further note, whilst the company's gross dividend yield does look attractive at over 7%, we have not currently classified the business as a star income stock. This is mainly due to issues around liquidity and concerns around the potential volatility of earnings and dividends. Of course, as you've just mentioned, Ken, with that past downgrade. Universal's average daily traded volume is around $400,000. So that does make it rather illiquid for large institutional investors, such as the Lincoln funds. Low liquidity can also impact volatility in terms of share price, and this is something that members need to be aware of as well. And these are, of course, just a few of the reasons why we've remained on the sidelines from an income point of view for Universal Store.
Yeah, it's quite interesting, isn't it, Dan? But looking at those metrics, especially under Golden Rule 2 and 3, dividends do appear sustainable with free cash flow expected to improve, while the payout ratio is also forecast to decline. Also, it is widely covered, with 12 analysts contributing to those forecast estimates, providing some reliability in those numbers. With the reporting season now behind us, a useful question, especially for newer members, is how can investors construct a portfolio from Stock Doctor's Star Stock universe?
Yeah, it's a very good question, isn't it, Ken? And one a lot of newer investors would have. The first step is certainly to determine your overall investment objective and tolerance to risk. Given that equities are a volatile but rewarding asset class in the long run, your allocation to equities will depend on your stage of life and, of course, your net worth. Once you understand this, you will then need to identify whether you are a growth or income investor. The portfolio constructor within Stock Doctor will help you set up your portfolio based on your own independent risk and return objectives.
Yeah, to access this feature, click on the Portfolio Constructor button within the Portfolio Manager tool. Follow the instructions in the pop-up window to narrow down on your investor profile. Are you a growth or income focus? Are you comfortable taking on an aggressive approach, or do you prefer stocks that are more conservative?
After selecting your preferred number of stocks and amount of investment capital, you then need to indicate whether you are sensitive to share price falls. For example, if you are trend sensitive, the Stock Doctor tools will only recommend stocks which have not triggered an exit on the SD30 TSR or SD Max.
And after confirming the industries you are comfortable investing in, the Portfolio Constructor will provide you with a list of star stocks. But make sure you go through the golden rules and read the analyst commentary, especially around the outlook and active risks, and remove stocks you're not comfortable with. And feel free to call our analyst research team if you are unsure about any stocks on that list. You can save this list of stocks to a watch list, print it, or even trade directly from this screen if you are connected to Bell Direct.
You can now create a portfolio using the stocks on the list by entering all your purchases, either through Bell Direct, as you've mentioned, Kien, or by manual entries. If you don't have enough stocks, you can then use the Portfolio Optimizer to help you generate new ideas. The Portfolio Optimizer uses an algorithm to come up with a list of suggestions to maximize the return to risk of your portfolio, taking into account your investment objectives and existing holdings.
Yeah, that's a very powerful algorithm there, Dan. Another option is you can simply replicate all the star growth or star income portfolio of stocks. That's all we have time for today, Dan, and thanks for your insights. It's always good to have you on board.
Great to be here, Ken. And as we mentioned at the start, an important episode given we're now officially in the federal rate cutting cycle. Also, next week, due to the grand final holiday in Victoria on Friday, there will be no Taking Stock video. However, for members, always feel free to contact us if you have any questions or attend our Lincoln Live webinars on Mondays.
Yeah, that's a good point, Dan. And just a reminder as well, we've rolled out a few services to help you make the most of your membership. We've got that Platinum Stock Doctor service. That's an exclusive community where you'll have direct access to Tim and the senior investment team, like myself. You'll be able to attend premium events and gain insights into your portfolio holdings. We've also got that virtual masterclass event that's fast approaching. So make sure you register for the event to help you learn everything you need to know about Stock Doctor to invest successfully. And last but not least, by referring your friend or family, you also have that chance to win a luxury winery experience at the Penfolds McGill's estate in South Australia. Remember, our business grows because of you, our members, and we appreciate your ongoing support and loyalty. In the meantime, take care and have a happy, healthy, and prosperous week ahead.